Welcome back to the Deep Dive. Today, we're really cutting through the noise, giving you a more direct path to understanding, well, the financial heart of any company. Forget those overwhelming reports. We're here to extract the crucial nuggets, the things that really matter.
Yeah, absolutely. It's easy to get lost in the details.
Let's dive right in then. Imagine having, I don't know, X-ray vision to instantly see a company's financial health, its performance, maybe even its future potential. That's kind of our mission today. We're exploring the essential world of financial statement analysis, or FSA, and we're drawing our insights from ZebraLearn's comprehensive guide on this.
Exactly. And this deep dive, it's all about equipping you to gain that knowledge quickly, but, thoroughly. And most importantly, not feeling overwhelmed by it all. You'll learn to spot what truly matters in a company's financial story. Make those statements less intimidating.
Okay, so to kick us off then, what exactly is financial statement analysis? It sounds, well, a bit dense maybe, but I know you can make it interesting for us.
Yeah, it can sound that way, but really at its heart, FSA is just a detailed investigation. You're digging into a company's financials to truly understand its performance. And the goal? Well, it's usually about making informed decisions. Are you looking to invest, lend money, just figuring out the risk? What's really fascinating here, I think, beyond just performance, is that FSA is a powerful tool. It can help you identify if financial statements might be manipulated, which is, a critical early warning sign for any serious analyst.
Manipulation. Wow. Okay. That's a strong word. Can you give us maybe just a quick high-level example how FSA helps uncover something like that, even before we get into all the details?
Sure, absolutely. A classic example. You'd look at a company's reported profits versus its actual cash flow from operations, the cash it's really generating. See, if profits are consistently high, climbing year after year, but the company isn't generating much actual cash, well, that's a bit of a red flag. It could suggest that the profits are being driven by, let's say, aggressive accounting choices rather than real economic activity. Like maybe they're booking sales way too early before the cash is even likely to come in.
Right. Profit on paper isn't the same as cash in the bank.
Exactly.
That's incredibly powerful. So, okay, beyond spotting potential manipulation, why is having this FSA skill so crucial for us, for our listeners?
Oh, its importance. It really can't be overstated. FSA, it reveals the past performance. It does this by breaking down financial metrics, KPIs, key performance indicators. And you're always comparing these against prior periods, past data. That helps us understand the trajectory. How has this company and its numbers evolved? But it's more than just looking back. FSA forms the bedrock, the foundation for predicting future performance. It helps with forecasting, even with doing comprehensive company valuations. It truly helps you understand the past, present, and potentially the future of a business. Gives you that holistic view.
Okay, that makes sense. And to get that holistic view, you mentioned financial statements. What are the key ones we should be focusing on?
Right. So to really understand a company's financial health, we primarily focus on three core statements, plus their notes. First, there's the balance sheet. Think of this as a financial snapshot, like a photo. Everything a company owns its assets, and everything it owes liabilities and equity at one specific point in time.
Like a snapshot. Got it. What's second?
Second is the profit and loss statement, the P&L. Some call it the income statement. This tells you the story over a period, maybe a quarter or a year. It shows the company's total sales, its revenue, minus all its expenses. Did it make money? How much did it spend to get that money? It reveals profitability.
Right, the bottom line for a period. And third?
Third is the cash flow statement. This one tracks all the cash, inflows and outflows, and it breaks it down, cash from operations, from investing, and from financing activities. It shows precisely how cash is generated and where it's being used. And honestly, this is often more telling than just looking at profits.
Cash is king, as they say.
It really is. And crucially, all these statements come with notes to accounts, sometimes called footnotes. These notes are vital. Don't skip them. They provide detailed explanations, breakdowns for the figures in the main statements. They clarify accounting policies, maybe disclose segment performance. They often hold a really important context. Seriously, read the notes.
Okay, good tip. So who are the actual real-world players putting FSA into action every day? Who uses this stuff?
Oh, a wide range of people and entities. Banks, for instance. They use it constantly to determine creditworthiness before lending money. They'll look at specific ratios like interest coverage or debt to equity. Then you have private equity and venture capital firms. They use it for making huge investment decisions. Although, admittedly, it's trickier for very early-stage startups with limited history. Business owners themselves rely on it for critical strategic decisions: should we raise capital? Which projects should we invest in? Entrepreneurs, even with less data, need it to make informed choices. And of course, credit rating agencies, think S&P, Moody's, they use FSA to assign those ratings, like AAA or BB plus R, which directly impact how much it costs a company to borrow money. Those ratings reflect changes in performance.
Makes sense. It touches almost everyone interacting with a business financially.
Okay.
Here's where it gets really practical.
Right.
Once we know what we're looking for, where do we actually get these numbers? The raw data itself.
Good question. The raw data primarily comes from a company's annual reports and also their quarterly results releases. Now, when you're just starting out actually manually pulling data from these reports, typing it into a spreadsheet, it can be incredibly insightful. You really learn the statements. But professionals, they typically rely on specialized data subscription services, things like Bloomberg, Capital IQ, FactSet. These provide standardized historical data, and they allow for automation, feeding data directly into financial models. Saves an immense amount of time.
Right, automation for the pros. But good to start manually, maybe. So once we have that raw data, whether we typed it in or downloaded it, what's the very first thing we should do before crunching any numbers?
Before you do anything else, you absolutely need to normalize the data. This is critical. It means making a few key adjustments to make the numbers reflect reality more closely, and crucially, to make them truly comparable across different time periods. We primarily do two big things here.
Okay, what are they?
First, we remove one-offs. These are non-recurring events. Things that happened in one year that made the company's financials look unusually good or bad, but aren't expected to happen again. Think of a huge one-time profit from selling a big piece of land, or maybe a massive loss because of a fire or a natural disaster. We strip these out because they won't repeat. They don't reflect the ongoing core business performance. It's like trying to judge a restaurant's normal Tuesday night business, but one year they happen to cater a massive wedding next door. That spike isn't typical.
Got it. Remove the unusual spikes or dips. What's the second thing?
Second, we adjust for discontinued activities. These are whole business segments or divisions that a company has stopped operating or has sold off. Since these parts of the business won't impact future performance, we remove their numbers, their sales, their expenses, their profits from the past data. This gives you a clearer picture of the continuing operations. So, if a company sold off its entire, say, electronics division last year, you'd remove all the electronics-related numbers from the previous year's data to focus just on the businesses they still run.
Okay, that makes perfect sense. Clean up the data first. This brings up something I often see mentioned. Standalone versus consolidated financial statements. Which one should we be using?
Yes. Good question. The rule here is pretty simple. Always, and I mean always, go for the consolidated financial statements. Unless, the company explicitly tells you otherwise, or if it's a very simple company that genuinely has no subsidiaries or significant investments in other companies, standalone statements only cover the core parent company, just that one legal entity. But consolidated statements include everything, all the subsidiaries, the parent controls, joint ventures, majority shareholdings. It gives you the complete financial picture of the entire economic group. Think about a big conglomerate like, say, Reliance Industries. The standalone statement might mostly reflect its core energy business, but the consolidated one includes huge segments like Geo Telecommunications and Reliance Retail. That's the real picture of the whole group.
Right. Consolidated for the whole story. Okay, so our data is clean. We're using the consolidated statements. Where do we look for that crucial stamp of approval, that assurance the numbers are actually reliable?
That would be the auditor's report. It's mandatory, at least for public companies. Every year, they have to get their financial statements audited by an independent third party, usually a firm of chartered accountants or CPAs. This report contains the auditor's opinion on whether the financial statements present a true and fair view. And what you always want to see is an unqualified opinion. That's the gold standard. It's basically a clean bill of health. It means the auditor believes everything disclosed is materially correct and presented fairly according to accounting standards.
So unqualified is good. What if it's not unqualified?
Right. Anything else is a potential warning sign. You might see a qualified opinion, which means the auditor found something potentially wrong or couldn't get enough evidence about a specific part, but the rest is okay. It's like a but. Then there's a negative or adverse opinion, which is really bad. The auditor is explicitly stating that the financials don't present a true and fair view. Something is seriously wrong. And sometimes you see a disclaimer of opinion where the auditor basically says they couldn't gather enough information to form any opinion. Also a major red flag. So you want that clean, unqualified opinion. And ideally, you want it from a well-reputed, big auditing firm, like one of the big four, for instance. Well, even that doesn't guarantee no manipulation is possible. Its absence or a qualified negative opinion significantly increases the chances of underlying issues.
Got it. Look for the clean opinion from a reputable auditor. Okay, so what about the company's own internal rule book, how they actually decide how to record things?
Right. That leads us to looking at the significant accounting policies. These are disclosed, usually in the notes we mentioned earlier. These are the specific guidelines and rules a company chooses to follow when preparing its financials within the broader accounting standards. They dictate really crucial things, like when exactly does the company recognize revenue? This can differ significantly. For an e-commerce company, maybe it should be after the customer's return window closes, not just when the order is placed. For a construction company, maybe it's only when the project is fully handed over.
So companies have some choice in these policies.
Yes, within limits. They can choose which acceptable accounting method to use for certain things. But the key is you need to check two things. First, do these policies make economic sense? Do they reflect the reality of the business? And second, critically, do they change year on year? A sudden, maybe unexplained change in a key policy, like revenue recognition, could be used to artificially inflate sales or profits in 1 year. It makes comparing numbers across years really tricky and potentially quite misleading if you're not aware of the change.
Okay, so consistency in accounting policies is important, right? With our data prepared, cleaned, and understanding the auditor's view and policies, let's start dissecting the actual statements, maybe the balance sheet first. What's a good way to begin there?
Yeah, the balance sheet. A good first step is to try and divide the items on the balance sheet into two broad categories: operating items and non-operating items. Operating items are directly related to the day-to-day core business. Think inventory, accounts receivable from customers, the machines used in production. Non-operating items are more financial in nature, things like surplus cash sitting in the bank, long-term investments in other companies' stocks or bonds. This distinction helps us start to understand the efficiency and health of the core business operations versus how the company is managing its financial assets.
Operating versus non-operating.
Mhm.
Okay. Now, you mentioned earlier a concept popularized by Warren Buffett called float. That sounds intriguing, almost like a business superpower.
Huh. It almost is like a superpower for businesses that can generate it. Float, it's basically capital that a company receives from external sources, customers, suppliers, etc., that it gets to use for a period without paying interest on it. And crucially, the company keeps any profits it earns from deploying that capital during that time. It's not equity, it's not traditional debt, it's float. Think about an insurance company. They collect premiums from policyholders up front, right? But they only pay out claims later, sometimes years later if it's for something like liability insurance. All that premium money they hold in the meantime, that's float. They can invest it and keep the returns.
Oh, okay. So insurance is a classic example. Are there others?
Sure. Think about advances from customers, like an Amazon Prime subscription. You pay upfront for the year, Amazon gets the cash now, but they only recognize the revenue bit by bit over the year as they provide the service. That upfront cash is float. Or even accounts payable, the money a company owes to its suppliers. If suppliers give you, say, 60 days to pay, but you sell your goods for cash immediately, like many retailers do, you're essentially using your supplier's money, interest-free, to fund your operations for those 60 days. That's float too. Some retailers have negative working capital. Because of this, they finance their inventory with supplier credit.
Wow. So essentially, a company with float is getting a free, interest-free loan from its customers or suppliers, which it can then invest and keep the profits from. That is quite the strategic advantage.
Exactly. It's a significant financing advantage. Not every business model can generate it, but those that do benefit immensely. Now, the flip side of this is what you might call reverse float. This happens when a company extends credit or pays in advance. Think about accounts receivable when a company sells goods on credit and has to wait to get paid by its customers. Or advances paid to suppliers. In these cases, the company's own capital is tied up. It's effectively lending money out, interest-free, which incurs a cost, the opportunity cost of not having that cash, and can lower overall returns. They're acting like the lender, not the beneficiary of float.
Float good. Reverse float. Less good, generally speaking.
Generally, yes, from a financing perspective.
That's a great distinction for thinking about capital. Now, let's pivot to a company's own big investment, its physical assets. You mentioned productive versus unproductive earlier. How do we look at that on the balance sheet?
Right. We look at fixed assets, often labeled as property, plant and equipment, or PP&E. Here we try to categorize them. Are they productive? Meaning, do they directly contribute to generating revenue? Think machinery on the factory floor, delivery trucks, the factory building itself. Or are they unproductive? Assets that don't directly contribute right now. Maybe it's excess land being held just for potential future appreciation, or fancy office furniture that doesn't really impact output. Ideally, you want to see a high proportion of productive assets. It's a just efficient use of capital. We can also do a rough estimate of the asset's life. You can estimate the original total life by taking the gross block, that's the original cost before any depreciation, and dividing it by the annual depreciation expense. And you can estimate the remaining useful life by taking the net block cost minus accumulated depreciation and dividing that by the annual depreciation expense. It's a bit like checking a car's total expected mileage versus how much is likely left on the odometer. It helps you anticipate when the company might need to spend significant money on replacing assets' future capital expenditures, or CapEx.
Okay, estimating asset life to predict future spending. Makes sense. Then there are the non-physical assets, intangible assets. Things like goodwill, patents, trademarks, software. How should we view those? They seem harder to pin down.
They can be tricky, yes. We often categorize them into roughly 3 types to help understand their value. First, there's stuff that might be labeled capitalized expenditure, but doesn't necessarily yield direct future economic benefit. Sometimes goodwill acquired in an expensive acquisition falls partly into this category if it doesn't really represent future earning power, or maybe some one-time fees. Second, there are normal assets, like computer software or maybe certain development costs, that do provide ongoing economic benefits necessary for operations. But often, the most valuable category is the third one, exclusivity. These are assets like strong patents, registered trademarks, valuable copyrights, things that give the company a real competitive edge. They allow it to maybe charge higher prices or protect its market share from competitors. Think of a pharmaceutical patent or the Coca-Cola brand name.
So the exclusivity intangibles are often the most valuable drivers of competitive advantage.
Often, yes. It's crucial to look for assets in this exclusivity category, and also, importantly, to recognize valuable intangible assets that might not even be listed on the balance sheet under accounting rules. Things like a super strong brand reputation built over decades, a unique company culture that fosters innovation, or a vast, efficient distribution network. These don't always meet the criteria for capitalization, but they can be incredibly valuable sources of competitive strength.
Right, the hidden value not always on the books. Okay, let's turn our attention now to the income statement, or P&L, and the cash flow statement. How do we spot trends and maybe find deeper meaning in those numbers?
Yeah, this is where common size analysis, especially for the income statement, becomes incredibly useful. What you do is you express every single line item on the P&L as a percentage of total revenue for that period. So cost of goods sold is X% of revenue, selling expenses are Y%, R&D is Z%, and so on, right down to net profit margin. What this does is it neutralizes the effect of overall company growth or decline. It lets you focus purely on the proportions, how much of each dollar or euro of revenue is being consumed by different costs. It really highlights the underlying cost structure and how it's changing over time.
Okay, common size. Everything is a percentage of sales. So with this view, what kind of specific stories or narratives start to emerge from the income statement?
Well, it really helps you track trends very clearly. For example, you might see the cyclical nature of the cost of goods sold, COGS, as a percentage of revenue for a company whose main raw material costs are linked to, say, volatile crude oil prices. Or you might see shifts in advertising spend as a percentage of sales. Maybe a company like Pedialyte, known for Fevicol, reduced ad spend during the peak of COVID-19 lockdowns. Seeing that percentage drop tells you something, though you'd also note that's likely not sustainable long-term for a consumer brand. You look for significant shifts in these percentages, and then you have to dig into the reasons behind them using the notes or management discussion. For instance, if employee expenses are steadily creeping up as a percentage of revenue, why? Is it because they're hiring more senior, experienced people in anticipation of growth? That could be good. Or is it just wage inflation without productivity gains? Less good.
Digging into the why behind the percentage changes.
Yeah.
Got it. Now, let's talk about the cash flow statement. You said earlier, cash is king. This is critical because a company can report high profits, but if that profit isn't actually turning into cash in the bank, it's a significant problem.
Exactly. It's fundamental. We look at the 3 key sections here.
Okay, let's break them down. What's the first area again?
First is cash flow from operations, CFO. This tells you how much cash the core day-to-day business is actually generating. A key check here is to compare the company's EBITDA, that's earnings before interest, taxes, depreciation, and amortization, which is a rough proxy for operating cash flow before certain non-cash charges and financing costs. Compare that to the actual CFO number from the cash flow statement. Ideally, they should be reasonably close. Big divergences need explanation. We also look at changes in working capital here, our receivables or inventory tying up more cash. And critically, we check if the actual income tax paid, shown in CFO, matches the current tax expense, shown on the P&L. If they're paying much less tax than they're expensing, why? Is it temporary? A really vital ratio I like to look at here is the sum of the last, say, 5 or 7 years CFO divided by the sum of those same years profit after tax, PAT. Ideally, this ratio should be somewhere between 0.8 and 1.2. It shows if profits are consistently converting into cash. If it's much lower than 0.8, it's a potential red flag about the quality of earnings.
Okay, CFO is the cash engine. Checking conversion from profit. What's the next section?
Then there's cash flow from investing, CFI. This section tells us how much cash the company is spending on investments, primarily long-term assets. We try to distinguish between operating CapEx, capital expenditure for maintaining and growing the core business assets, like buying new machines, building a new factory, and financial CapEx, which is more about investing in financial assets, like buying stocks or bonds of other companies or making loans. We want to understand where the CapEx is going. Which business segments are getting the investment? What types of assets are they buying? If CFI is a large negative number, it means the company is investing heavily, presumably for future growth. That's not necessarily bad at all, but we need to know how that investment is being funded. Which brings us to the third section.
Right. If they're spending a lot on investing, where's the cash coming from? Which is CFF.
Exactly. Cash flow from financing, CFF. This section reveals how a company finances its operations and investments. It shows cash coming in from issuing debt or equity and cash going out for repaying debt, buying back stock, or paying dividends. We look at things like the dividend payout ratio, how much profit is paid out versus reinvested. We track debt levels. Are they taking on more debt or paying it down? Are they issuing new shares, diluting existing shareholders, or buying back shares, concentrating ownership? CFF helps us understand if the company is self-sufficient funding its growth from its own operations, CFO, or if it's relying heavily on external capital, debt, or equity from the financing section. For example, if that CFI number, investing cash outflow, is consistently much larger than the CFO number, operating cash inflow, the company has to be getting the extra cash from somewhere. It's either coming from CFF taking on debt or issuing equity, or it's depleting its existing cash reserves shown on the balance sheet. Understanding that funding source is crucial.
Okay, so the 3 cash flow sections tell a story, where cash comes from, CFO, where it's going, CFI, and how any gaps are filled, CFF. We've built quite a solid financial picture now. But what about those deeper insights, maybe hidden things, potential pitfalls we should look out for beyond the main statements?
Absolutely. You've got the foundations, but the real analysis often involves digging into the details disclosed elsewhere, usually in the notes or specific sections of the annual report. There are several critical areas to scrutinize. First, major business segments. If a company operates in multiple distinct areas, like different product lines or geographic regions, they usually have to disclose information for segments that contribute more than, say, 10% of the consolidated revenue or profit or assets. We need to analyze each significant segment's revenue growth, its profitability, segment margins, how efficiently it uses its assets, and its overall growth trajectory. This helps you understand which parts of the business are really driving value and which might be struggling or dragging down the overall results.
So, breaking down the conglomerate view, what else?
ESOPs, employee stock option plans. These are common, especially in tech or growth companies, but they can lead to equity dilution for existing shareholders. You need to understand what percentage of the company's total equity is potentially outstanding as ESOPs.
Right.
What's the company's policy on granting them, how often, who gets them, what are the exercise prices and vesting periods, and what's the potential impact on earnings per share and ownership if all these options are exercised?
Right, dilution is key for shareholders. Keep going.
Leases. Especially after recent accounting changes like IFRS 16, companies have to put most leases onto their balance sheet as assets and liabilities. We need to analyze the size and structure of these lease liabilities and payments. How big are they compared to revenue or total assets? For businesses that rely heavily on leasing, think retailers with store locations, airlines with planes, maybe a warehouse company. Understanding the terms is key. Are there cancellation clauses? What are the renewal options? How long do the leases run?
Okay, leases is hidden debt, almost.
In a way, yes. Then forwards or derivative contracts. Companies often use these financial instruments to hedge against certain risks. Maybe fluctuating raw material prices, like an airline hedging fuel costs, or changing interest rates on their debt, or foreign currency exchange rate movements if they operate internationally. For example, a company like Pidilite might hedge its foreign currency risk from international sales, but perhaps it chooses not to hedge its raw material price exposure, like VAM linked to crude oil. That's a conscious risk management decision. We need to evaluate how effective is their hedging. Are they experiencing significant gains or losses from these contracts or from the exposures they don't hedge?
Hedging, or lack thereof. That makes sense.
Yeah.
What about dealings within the company family?
Ah, yes. Related party transactions. This is a big one to watch. These are transactions between the company and parties that are related to it, or its management could be subsidiaries, associate companies, key executives, major shareholders, or even companies controlled by the executives' families. Now, some related party transactions are perfectly normal and necessary, like sales between a parent and its subsidiary. But you need to be vigilant. Look for large or suddenly increasing transactions, especially with key managing personnel or companies associated with them. Why? Because it potentially opens the door for management or controlling shareholders to benefit themselves at the expense of minority or common shareholders. Maybe the company is buying goods from a related party at inflated prices or selling to them too cheaply. We look for the size of these transactions relative to the company's overall profit, PAT, as a key indicator. Significant related party dealings warrant very close scrutiny.
Potential conflicts of interest there. What about things that might happen in the future? Potential problems.
Exactly. That brings us to contingent liabilities. These are potential future obligations that depend on some uncertain future event. The classic example is a pending lawsuit against the company. The company has to disclose significant contingent liabilities in the notes. It's crucial for us to evaluate the potential impact. What's the worst case scenario? How much could the company realistically have to pay out if all these potential liabilities actually materialized? Then you compare that total potential payout amount to the company's annual profits and its total assets or net worth. Can the company comfortably handle it if the worst happens? For instance, using your example, a 350 crore contingent liability might be quite manageable for a large company earning 1,000 crore in profit annually. But if that same company faced a potential liability of 3,000 crore, that could be an existential threat. So context and scale are key.
Assessing the what-ifs. Okay, this has been incredibly thorough. After digging through all of this, the statements, the notes, the policies, these other areas, how do we finally pull it together and spot the actual red flags? The warning signs that might indicate serious underperformance, or even, going back to your earlier point, potential manipulation.
Right, identifying red flags is a critical output of this whole process. These are the warning signs that tell you. Pause, investigate this much deeper. They don't automatically mean fraud, but they demand serious attention. Here are some common ones. 1. Unusual borrowing or lending rates. If the company is borrowing money at extremely high interest rates compared to peers, or perhaps more suspiciously, lending money out, especially to related parties, at unusually low rates. Why? 2. Frequent changes in key personnel. High turnover in the chief financial officer, CFO position, or frequent changes in the company's independent auditors. This can sometimes indicate disagreements over accounting or underlying problems. 3. Very high related party transactions. We just discussed this. Especially if a significant related party is also one of the company's main suppliers or customers. The potential for conflicts is high. 4. Ineffective corporate governance. Signs that the board of directors isn't truly independent or lacks proper oversight. Maybe one or two individuals seem to completely dominate all decision-making without adequate checks and balances. 5. Large increases in receivables or inventory. If accounts receivable, money owed by customers, or inventory levels are growing much faster than sales without a good business reason, this can artificially inflate reported sales and profits, and it also traps cash and working capital. It could indicate problems selling products or even fictitious sales. 6. Frequent changes in accounting policies. As we mentioned, if a company keeps changing how it accounts for things, it makes year-on-year comparisons difficult and could be a way to artificially boost reported performance. 7. Large or frequent provisions, write-offs, or restructuring charges. While sometimes necessary, consistently large write-offs might indicate ongoing operational inefficiencies, or in some cases, could even be used to manipulate earnings or mask other issues. 8. Major unexplained changes in common size ratios. If a key expense ratio suddenly jumps from, say, 3% of revenue to 16% without a clear, logical business explanation provided by management, that needs investigation. 9. Line items not matching industry norms. If a company operates in an industry where, for example, warranty expenses are typically significant, but this particular company reports zero warranty expense, that's odd and needs understanding.
That's a great list. So these are signals to dig deeper, not necessarily run away immediately.
Exactly. They are warning signs, not definitive proof of wrongdoing or failure. They necessitate a pause. You need to go back to the annual reports, read management's explanations, if any, maybe listen to earnings calls. If you can find convincing, logical reasons for these flags, maybe it's okay. But if the reasons are unconvincing, vague, or completely absent, then yes, that's a strong signal to be very, very cautious, or perhaps even decide this company is too risky or opaque to invest in or lend to.
Wow. We have covered a tremendous amount of ground today, really moving from those foundational elements, the basic statements, all the way through to the nuanced secrets they can hold, and even these critical red flags that demand our attention.
We really have. And remember, the absolute key to truly mastering FSA isn't just learning the ratios or the checklist. It's practice, patience, and persistence.
Mhm.
Don't just look at the numbers in isolation. Always try to connect them back to the underlying business. Think about the actual products, the Fevical and Feviquick, behind Pedialyte's financials, for example. How does the business work? And compare. Compare the company to its peers. Compare it across different industries. That's how you build your benchmarks, your intuition for what looks normal, what looks good, and what looks off.
That's great advice. Focus on the business reality behind the numbers. So maybe a final thought for our listeners. If you were looking at a company, maybe you were the CEO, and your accounts receivable suddenly jumped by 20% in a single year, way faster than sales. What specific conversation would you be having internally to understand why? That's the kind of critical thinking, that why question, that we're encouraging you to develop through FSA. So go forth, analyze, and as you said, keep digging deeper.